There is a tremendous amount of assets here that I really have a hard time believing that this deal gets done for under $15 a share. And if it does, I think something is tremendously wrong here. Welcome back in, ladies and gentlemen. If you've been following the Paramount drama and been confused, you are not alone. This has been a disaster of a company as of late, and I definitely think there's some shadiness going on with this deal. We're going to get into the two deals that are on the table, break them down, and I'm also going to talk broadly about the market, where I see opportunities. So let's get into it. Now, I did a video over a year ago, probably closer to 2 years, and getting a valuation of Paramount sitting right around $15 a share. Now, if we look at the 1 year chart of Paramount, it is down 43% on the year. Now, I personally have been buying around $10 a share because when I updated my analysis from a year ago, I actually thought underneath $11 made a tremendous amount of sense for Paramount Pictures. And so I did a video breaking down how much I thought this company could sell for by separating the assets, and it's actually a lot more because the assets individualized is more valuable than the business as a whole. Paramount's been getting offers for CBS and Nickelodeon just by itself for right around $10 to $14 billion. The company's current valuation, market cap is sitting at $8.5 billion, but we have to factor in debt as well. So when we think about debt, we have to look at enterprise value for the stock. And we can see enterprise value has come down drastically, sitting right around between $20 to $22 billion is right around what we see for the company for enterprise value. Now, here's where this story gets a little bit shady. Now, they recently turned down an offer from Apollo to be in exclusive talks with Skydance Media. So Apollo actually offered them what I thought was a decent, compelling offer that made a lot of sense where I thought the company should be bought. I definitely think the company should be bought for right around $19 and above, between $19 and $25, call it, without factoring in debt. So Shari Redstone owns 77% of Paramount's voting rights, which is now becoming a big problem in all this. And now board members are starting to step down from Paramount Pictures. And the person I want to point out is former Sony Entertainment president Cole Seligman. This will be an important part of the story going forward here. Just remember Sony in all of this. So just to go back, on March 31st, private equity firm Apollo Global Capital offered to acquire Paramount for $27 billion, but Paramount's board declined to engage, mainly due to the fact that they didn't think Apollo truly had funding to put this deal through. And there's already been talks with Warner Brothers Discovery trying to acquire Paramount or merge with Paramount as well. So there's definitely lots of talks about this asset being up for sale, because it's pretty cheap asset overall, and we'll go over that in a minute. But Apollo's deal was going to be worth $21 a share. Currently, the stock is trading around $12 a share and as low as $10 a share, meaning that there is over 100% upside, or was 100% upside in this deal for shareholders, which I think is fair because this has been a pretty ugly story. But if this deal goes through for Skydance, they're projecting out that it's going to be right around an $11 deal for shareholders, which means that they're basically getting a hugely depressed asset at a market price right now, which means it's heavily discounted. And this is where litigation can come in for Shari Redstone. If there is a true offer on the table that benefits shareholders and it's that big of a divergence, we're definitely going to see some litigation at this point in time. But now the Apollo deal is actually looking a lot more serious because they have some deeper pockets. As of 1 day ago, Sony is now in talks to join a bid to buy Paramount with Apollo. So now it looks like Sony and Apollo are going to do a joint venture to acquire Paramount Pictures, most likely to that $21 a share type of purchasing. Now here's what would be interesting. If Sony throws out a little bit of a better deal, juicing it up just a little bit more here. But regardless, the deal that was taking place, and a big reason why I sold a large part of my Paramount, I bought at 10, I sold half my position at 13, because it seemed that the deal with Skydance was very dilutive and was almost shady type of deal here. So this kind of sums up the drama that's taking place with Paramount right now. And when we think about this company as an asset, this is a company that has over 65 million people on its platform, does right around $30 billion of revenue. And yes, the company is not really being efficient, but to buy it for an $8 billion market cap and a $20 billion enterprise value when this company's pushing out $30 billion in revenue. And we have to factor in how much would it actually cost if you started from square one to build out CBS, Paramount Pictures, Paramount Studios, hundreds of years of videos and films, entering the streaming world and getting 65 million users on the platform that are paying a monthly payment. When I heard the Skydance deal going through and I heard it could be dilutive, I sold at $13 a share. I was in for $10 a share, which means that even if I got $11 a share afterwards, I still would have a position there and I took some profits. But now that Sony's back in the mix here, backing up Apollo, this is where I think Paramount as a whole has multiple offers out on the table that could start up a bidding war here. So this is definitely getting to be an interesting story, and I'm sure we haven't heard the end of it just yet. Now, personally, I think if Paramount got offered anything less than $15, $16 a share, that they should probably just to keep the business as a whole, lean it out, sell some of the assets, fix the balance sheet, and just keep on the streaming world and just be a discounted streamer. But of course, this is just my opinion. Now, if you want to hear something pretty comical here, Netflix reported earnings and it came down 10%. This company was trading for just under a $300 billion market cap, which means that it lost $30 billion in market capitalization, which would have been able to buy Paramount Pictures. I know that sounds crazy, guys, but it is the truth. And this was one of the players that I thought would actually scoop up Paramount for multiple reasons. I'm not going to talk through it again, but anybody that's been subscribed to the channel knows why I thought they were a perfect fit for Paramount. So now we have an overall market that's been selling off as of late. The current market is now trading at 25 times earnings, roughly 20 times forward earnings, maybe 21 times forward earnings. And this is where I said the market's still just a little too rich for my likings. And I definitely been way overweight fixed rates and picking my spots to buy deeply discounted assets. In my opinion, the market's kind of in a euphoric stage. It's trading at high valuations with a lot of global political tension. I don't see a tremendous amount of motivation to be putting new capital in at these valuations. But if earnings do deteriorate, this will be bubble territory very fast, which means that if we don't have 10+% earnings growth over the next year, then we're probably trading closer to 22, 23 times earnings, forward earnings, and this is where it could get a little bit frothy. Now, we currently have yields over 5%, which means if we were to do an apples-to-apples comparison, the market versus fixed rates, at what point in time does it make sense to be a little bit more overweight on fixed income or on yields versus the stock market? And so if we have rates pushing right around 5.3 to 5.4%, you're looking at 18 and a half times earnings on a pretty risk-free asset versus going into a riskier asset paying a higher multiple at 24 times earnings, which is shown to be a historically high valuation for the stock market. Could we have a 20 to 30% correction? Absolutely, that could happen, especially when we think about all the political tension that's taking place. We're in an election year, and there's definitely some crazy chaotic things happening to where at any given point in time, there definitely could be a shoe that drops. Now, this doesn't mean that stocks are going to underperform bonds. This just means if I'm looking at it from an unbiased opinion and I am looking at it from a risk versus reward standpoint, and I might not have a long time horizon, there's definitely a compelling story to look at a 5.4 and above yield versus a 24, 25, or 26 times earnings S&P 500. Now, of course, we can see the market skyrocket and go to 30 times earnings. That's absolutely on the table, but you have to factor in what is your downside risk at this point in time, which is going to lead into the next point of where I think some of the best opportunities are. I definitely believe this is a stock picker's market, and I do think there's some generational buying opportunities. I've obviously brought up healthcare numerous times on this channel, everything from Johnson & Johnson, Bristol Myers Squibb, Pfizer, CVS. There is a lot of healthcare out there that I think is very, very cheap. Another area that I brought up that I think is getting very, very interesting, and normally I'm not a big REITs person because I think owning the actual asset overall makes a lot of sense, but most people want a passive approach to investing, especially when we're investing in the stock market, and REITs can definitely give you that passive opportunity. And so I do think when we look at some of the REITs that are out there, Realty Income being obviously one of the most popular ones, it's basically trading pretty darn close to 5-year lows. And it's a well-diversified portfolio that pays a monthly dividend sitting over 5.8% right now. Now, I don't think the bottom is in on REITs, so I'm not saying go out and buy REITs, but definitely put them on your radar because I do think there's an opportunity for rates to spike once again. And this is why I'm personally sitting on the sidelines in over 5% yielding treasuries. Because if you look at the overall returns on REITs here, And most REITs are going to be trading very similar to Realty Income because this is kind of the powerhouse of all REITs. And so Realty Income has been trading slightly down here. It hit a high of $78, currently trading at $53. So when we look at total returns on this company, it's definitely down, and we look at a 5.8% yield. This is why I'm saying treasuries are very compelling right now, because you could have earned 5.4% over the last few years. As interest rates go higher, which I do think is going to happen when we look at the deficits the government is running, stocks are definitely going to start feeling the pressure of this higher for longer. Absolutely, it's going to impact bottom lines, and it's specifically going to impact REITs and healthcare. And you're probably asking yourself, well, why is this impacting them? Higher interest rates are going to ruin cash flows and growth opportunities for REITs because they leverage 50% or more on properties that they purchase. So the cash flows are going to get smaller and smaller as yields go higher, which means they are not going to be making as much money. Same thing for healthcare. There's a direct correlation with a lot of healthcare and interest rates because a lot of healthcare scoop up biotech companies, invest to stay ahead and build out their pipelines, which means they rely on debt being cheap in order to kind of stay ahead of the game. And once again, similar situation to the REITs, it's going to impact their future cash flows. So hopefully everybody enjoyed that, and we will see you in the next one.